all of us would have to agree that these valuation levels seem a bit extended given the fact that there's no real news or resolution on the trade front. And yes, the Fed is positive, but valuations are higher and earnings growth is trending lower.
Yeah, what specifically do you have in mind in terms of what earnings season is going to look like?
Well, right now, Q2 forecast per FactSet is for the overall earnings estimates to be down about 2.5%, which is a stark difference from where we were 6 months ago, which projected Q2 earnings to be up at around 2.5%, almost 3%. So with CEOs telegraphing more negative comments as it relates to expectations for sales and capex plans, it's understandable why Wall Street has lowered those estimates quite a bit.
Stephen, do you agree that earnings season could hurt equity markets?
I believe that it could hurt the equity markets, but I think the backstop is going to be the Fed, because if the Fed gets wind of a negative earnings period or negative to the point that it will hurt the equity market, I think that the Fed will press a little bit on the dovish gas pedal, so to speak.
Why doesn't that encourage you to be more bullish, Rebecca? Over the years post-crisis, when the Fed goes easy, typically the market likes that.
Right, but we have to have earnings growth to see multiple expansion from here. And I think that there is reason to pause because last year, in 2018, for the year, almost all sectors of the S&P had double-digit earnings growth. So when we start seeing negative numbers year over year for Q2, it could cause some sort of a, wait a minute, we're a little extended at about a 16-plus trailing or forward multiple versus the 5-year and 10-year averages. We're right up at the highs.
Steve, when you see the small caps underperforming like they are today, is that a concern for you?
Sure, there's a lot to be concerning in this marketplace, and I think Rebecca's right to be concerned about the host of issues that she's worried about. But we both could have said that a month ago or a month and a half ago, and you would have missed the rip that you've seen in the markets right now. So the markets are clearly focusing on stuff that professionals and fundamental strategists and analysts aren't looking at, and it's the Fed. It's trade, and it's macro, not micro. So I think the market can still move higher inexplicably to a lot of the participants.
Rebecca, just quickly, your picks in terms of sectors of where to avoid some of these macro issues.
Well, we're looking deeper into some of the sub-industries. Certainly technology, it's well telegraphed that earnings will be down year over year. So in that area, we're tilting towards software and services. And in healthcare, we have a bias towards medical devices, expecting that perhaps they won't be as heavily scrutinized in the current regulatory environment.